Welcome to this lesson in understanding bonds. Bonds are a vital enabler of growth for companies worldwide, and understanding the rules and practices in bond issues will help you advance your career in senior management. A bond is a debt instrument generally issued to many investors that requires future repayment of the original amount at a fixed date, as well as periodic interest payments during the intervening period. A company seeking to borrow millions of dollars generally is not able to borrow from a single lender. By selling or issuing bonds to the public, the company secures the necessary funds. Usually companies sell their bond issues through an investment company or a banker called an underwriter. The underwriter performs many tasks for the bond issuer, such as advertising, selling, and delivering the bonds to the purchasers. Often the underwriter guarantees the issuer a fixed price for the bonds, expecting to earn a profit by selling the bonds for more than the fixed price. Stocks are securities that represent a fraction of the ownership of the issuing corporation. They are issued to investors in the form of stock certificates. Bonds are a fixed obligation to pay that are issued by a corporation or government entity to investors. They usually include a periodic coupon payment and are paid off as of a specific maturity date. The bond market is where investors go to trade debt securities, prominently bonds, which may be issued by corporations or governments. The bond market is also known as the debt or the credit market. Securities sold on the bond market are all various forms of debt. By buying a bond, credit, or debt security, you are lending money for a set period and charging interest, the same way a bank does to its debtors. This chart provides a useful illustration of the main differences between bonds and stocks. Have a look in detail and consider the implications for your own business. In issuing bonds, a contract called a bond indenture is prepared between the corporation and the future bondholders. It specifies the terms with which the corporation will comply, such as how much interest will be paid and when. Another of these terms may be a restriction on further borrowing by the corporation in the future. A trustee is appointed to be an intermediary between the corporation and the bondholder. The trustee administers the terms of the indenture. Ownership of a bond certificate carries with it certain rights. These rights are printed on the actual certificate and vary among bond issues. Individual bondholders always acquire two rights. The first is the right to receive the face value of the bond at a specified date in the future, called the maturity date, and the second is the right to receive periodic interest payments, usually semi-annually, at a specified percent of the bond's face value. Every corporation is legally required to follow a well-defined sequence in authorizing a bond issue. The bond issue is presented to the board of directors by management and must be approved by shareholders. Legal requirements must be followed, and disclosure is required in the financial statements of the corporation. Shareholder approval is an important step, because bondholders are creditors with a prior claim on the assets of the corporation if liquidation occurs. Further, dividend distributions may be restricted during the life of the bonds. Affected shareholders usually need to approve this. There are as well several additional considerations related to the decision to issue bonds. The first consideration is the cash required in the immediate and the foreseeable future. The second is the important terms of the bonds. And the third consideration is the assets of the corporation to be pledged. Let's look briefly at each of these. Most bond issues are sold in their entirety when market conditions are favorable. However, more bonds can be authorized in a particular bond issue than will be immediately sold. Authorized bonds, like authorized share capital, can be issued whenever cash is required. The interest rate of the bonds, their maturity date, and other important provisions, such as convertibility into share capital, and restrictions on future dividend distributions of the corporation, are also considered. The success of a bond issue often depends on the proper combination of these and other similar features. Whether long-lived assets like property, plant, and equipment are pledged as security is an important consideration for bondholders, because it helps to safeguard their investments. It is important to the corporation, because the pledging of all these assets may restrict future borrowings. The total amount of authorized bonds is usually a fraction of the pledged assets, for example, 50%. The difference represents a margin of safety to bondholders. The value of these assets can shrink substantially, but still permit reimbursement to bondholders, should the company be unable to pay the bond interest or principal, and need to sell the pledged assets. There are three main categories of bond terms. These are shown here and include terms relating to the different types of bonds, terms relating to special features of corporate bonds, and the amount printed on the bond certificate. Let's look now at some of the advantages of bonds. Bonds have a clear advantage over other securities. The volatility of bonds, especially short and medium-dated bonds, is lower than that of equities or stocks. In addition, the interest payments of bonds are sometimes higher than the general level of dividend payments. Bonds are often liquid. It is often fairly easy for an institution to sell a large quantity of bonds, without affecting the price much, which may be more difficult for equities. In effect, bonds are attractive because of the comparative certainty of a fixed interest payment twice a year, and a fixed lump sum at maturity. Bondholders also enjoy a measure of legal protection. Under the law of most countries, if a company goes bankrupt, its bondholders will often receive some money back, the recovery amount, whereas the company's equity stock often ends up valueless. Furthermore, bonds come with indentures. An indenture is a formal debt agreement that establishes the terms of a bond issue, and covenants, the clauses of such an agreement. Covenants specify the rights of bondholders and the duties of issuers, such as actions that the issuer is obligated to perform, or is prohibited from performing. There are also a variety of bonds to fit different needs of investors, including fixed-rate bonds, floating-rate bonds, zero-coupon bonds, convertible bonds, and inflation-linked bonds. Bonds are also subject to various risks, such as call and prepayment risk, credit risk, reinvestment risk, liquidity risk, event risk, exchange rate risk, volatility risk, inflation risk, sovereign risk, and yield curve risk. Price changes in a bond will immediately affect mutual funds that hold these bonds. If the value of the bonds in the trading portfolio falls, the value of the portfolio also falls. This can be damaging for professional investors such as banks, insurance companies, pension funds, and asset managers. If there is any chance a holder of individual bonds may need to sell his bonds and cash out, the interest rate risk could become a real problem. Price changes in a bond will immediately affect mutual funds that hold these bonds. If the value of the bonds in the trading portfolio falls, the value of the portfolio also falls. This can be damaging for professional investors such as banks, insurance companies, pension funds, and asset managers. If there is any chance a holder of individual bonds may need to sell his bonds and cash out, the interest rate risk could become a real problem. Additionally, bond prices can become volatile, depending on the credit rating of the issuer. For instance, if credit rating agencies like Standard & Poor's and Moody's upgrade or downgrade the credit rating of the issuer, an unanticipated downgrade will cause the market price of the bond to fall. As with interest rate risk, this risk does not affect the bond's interest payments, provided the issuer does not actually default, but puts at risk the market price, which affects mutual funds holding these bonds, and holders of individual bonds who may have to sell them. A company's bondholders may lose much or all their money if the company goes bankrupt. Under the laws of many countries, including the United States and Canada, bondholders are in line to receive the proceeds of the sale of the assets of a liquidated company, ahead of some other creditors. Bank lenders, deposit holders and trade creditors may take precedence. There is no guarantee of how much money will remain to repay bondholders. In a bankruptcy involving reorganization or recapitalization, as opposed to liquidation, bondholders may end up having the value of their bonds reduced, often through an exchange for a smaller number of newly issued bonds. Finally, some bonds can be called, meaning that even though the company has agreed to make payments, plus interest toward the debt for a certain period of time, the company can choose to pay off the bond early. This creates reinvestment risk, meaning the investor is forced to find a new place for his money. As a consequence, the investor might not be able to find as good a deal, especially because this usually happens when interest rates are falling. A bond is a debt security that necessitates periodic interest payments during its life, as well as a future repayment of the borrowed amount. A bond indenture is the contract that binds the corporation to the bondholders. It specifies the terms with which the corporation must comply, and may restrict further borrowing by the corporation. A bondholder has the rights to receive the face value of the bond, at a specified maturity date in the future, to receive periodic interest payments at a specified % of the bond's face value, and in some cases, to have the corporation pledge assets, to protect the bondholder's investment. If the bond contract interest rate is the same as the prevailing market interest rate, the bond will sell at par. If the bond contract interest rate is higher than the prevailing market interest rate, the bond will sell at a premium. If the bond contract interest rate is lower than the prevailing market interest rate, the bond will sell at a discount.
Want to learn more about this subject? Then click on our website to view the full course. Why not subscribe and get access to free articles and special offers? Join the Global Career Highway now.